Very good day, friends. In this video, we will cover the statutory updates for your taxation paper, both income tax and GST, which are relevant for CA Inter May 2024 examinations. This video is relevant if you are studying from TaxBook Plus for your CA Inter May 2024 exams. Now, as you would be aware, ICAI has also recently released its list of statutory updates for May 2024 examinations. Now, the study material of ICAI was updated till 30th April, and the cutoff date for the law which is relevant for May 2024 is 31st of October, and therefore the statutory update which has been released by ICAI covers the updates from 1st May 2023 to 31st October 2023. And if you look, these are the updates for income tax, and similarly a document has been released by ICAI covering the statutory updates for GST as well. Now, most of these already find place in the TaxBook Plus, because TaxBook Plus, if you note, if you see the first page of your book, TaxBook Plus is already fully updated till 15th of October. So basically, for around a fortnight, we need to cover the statutory updates and a few other points as well. And this will make you fully ready for the upcoming May 2024 examinations. Now, as far as income tax is concerned, so we will first pick up income tax and then we will move on to GST. As far as income tax is concerned, basically we need to cover two items. One is in respect of exemption for life insurance policy proceeds, which is section 1010D. And the second is a point which we need to cover in respect of section 43B, which is deduction only on actual payment. So first we will move on to section 1010D, and which deals with exemption in respect of life insurance proceeds. CBDT has issued circular number 15 of 2023, which contains certain guidelines and illustrations. So in nutshell, basically 3 points need to be taken care of. One, the CBDT has provided certain illustrations which explain the impact of the amended provisions. That means provisions as amended by the Finance Act 2023. Now the amended provisions are given in TaxBook Plus. What we need to now look at are the illustrations which have been highlighted by CBDT, which will give us a better understanding of the application of those amended provisions. Second item pertains to GST component, and third pertains to term life insurance policy, and all these three we will look at. But before we do that, it will be useful to quickly recap the basics of section 1010D, so that it will help us understand the statutory updates from a better perspective. So what is the exemption provided by section 1010D? Let's look at the basics. And it depends on the type of the life insurance policy. It can be a key man insurance policy or an excess premium policy or any other policy. As far as the key man insurance policy is concerned, the proceeds are taxable whether received on death or otherwise. As far as excess premium policy is concerned, proceeds received on death are exempt, but if the proceeds are received otherwise than on death, they are taxable. As far as any other policy is concerned, the sum continues to be fully exempt under section 1010D. So our focus will be on excess premium policy, in respect of which the sum received on death is exempt, but in all other cases it is taxable. What is an excess premium policy? A policy is classified as an excess premium policy when either one or two are fulfilled. What is one? Premium payable for any of the policy year exceeds a prescribed percentage of the sum assured, and the prescribed percentages are given in this table. So we need to look at the date when the policy was issued, and then we need to see whether the premium payable for any of the policy year exceeds the prescribed percentage. which depending on the date of issue of policy is either more than 20% or more than 10% or more than 15%. So basically 10%, 15%, 20%. If the premium payable for any of the policy year is more than this threshold, then the policy is classified as an excess premium policy and consequently the proceeds are taxable, right? A policy is also considered as an excess premium policy when the condition in serial number 2 is satisfied. And this is the amendment. This is a new provision brought in by the Finance Act 2023. And the condition is that the policy is issued on or after 1st April 2023. And the premium payable for any of the policy years is more than rupees 5 lakh. So one, we need to check whether the policy is issued on or after 1st April 2023. If the policy is issued before 1st April 2023, serial number 2 is not applicable and we need to only check serial number 1 to find out if the policy is an excess premium policy. If the policy is issued on or after 1st April 2023, then we need to further check if the premium payable for any of the policy years, that means even if for 1 year, that will be sufficient, for any of the policy years is more than rupees 5 lakh. Okay. Now there could be a situation where a person has multiple insurance policies and the premium is payable for more than one policy. What happens in that case? The provision says that if the premium is payable for more than one policy, a person may have 2 policies, 3 policies, 4 policies, 5 policies and so on. For more than one policy, but we need to check only those policies which have been issued on or after 1st April 2023 because that is the basic condition that we saw in serial number 2. Because if this basic conditions in respect of date of issue is not satisfied, then we need not consider serial number 2 for classification of a policy as an excess premium policy. So the basic condition is the date of issue, which should be on or after 1st April 2023, and if more than one policies are such as have been issued after this date, on or after this date, then the exemption under section 1010D may not be available in respect of all the policies. Even if the premium payable for each of those policies is less than 5 lakh, is not more than 5 lakh, right? Because if the premium payable is more than 5 lakh, then straight forward case is that the policy becomes an excess premium policy. But there may be several smaller premium policies where for say each of them, or for say one or more of them, the premium is not more than rupees 5 lakh. Then the question is, what will be the treatment in that case? In that case, the exemption will be applicable only with respect to those policies where the aggregate amount of premium does not exceed rupees 5 lakh in any of the policy years, right? So if there is a policy, if there are say multiple policies taken after on or after 1st April 2023, and if say policy A has a premium of 1 lakh rupees, policy B has a premium of 3 lakh rupees, policy C has a premium of 6 lakh rupees. So as far as 6 is concerned, it's clear that the premium is greater than rupees 5 lakh and all these policies have been issued on or after 1st April 2023. So C is not exempt. So proceeds become taxable for C. But as far as A and B are concerned, the aggregate of the premium is 4 lakh, which is not more than rupees 5 lakh. So proceeds from A and B will be exempt under section 1010D. In nutshell, this is the effect, right? So these are the basic provisions, and after that, okay, the point to note is that the Finance Act 2021 had disallowed exemption under section 1010D in respect of high premium ULIPs. However, high premium ULIPs are not part of the CA intermediate syllabus, so these are out of our scope of the discussion in this video, and also these have not been covered in TaxBook Plus. Then there are certain illustrations. There are 7 illustrations in all. Hope you have gone through these. My suggestion will be that you go through the provisions in TaxBook Plus and you go through these illustrations, and that will help you in better understanding this statutory update which we will now discuss. So these are the illustrations which have been given in the TaxBook Plus and certain questions, right? And now we come to the statutory update, which is the circular issued by the CBDT. So we will first look at the illustrations which have been provided in the circular, and the other 2 points which was in regard to the GST component and the treatment in respect to the term insurance policies. So as far as illustrations are concerned, in these guidelines, the illustrations have been classified under 2 situations, situation 1 and situation 2 basically, right? Situation 2 covers those cases where consideration has been received by the SSE under any one or more eligible life insurance policies. What are eligible life insurance policies? Which we consider while classifying the policy as an excess premium policy, that means issued on or after 1st April 2023. So consideration has been received under one or more eligible life insurance policies during any preceding previous year. That means previous year preceding the current previous year. That means in an earlier previous year, the consideration has been received, the proceeds have been received and they have been claimed exempt under section 1010D, right? And why is this situation important? This situation is important, or this situation is relevant because in the case of multiple insurance policies, as we noted some time back, what happens? The exemption is provided under section 1010D only in respect of those policies where the aggregate amount of premium doesn't exceed rupees 5 lakh in any of the policy years. So basically the aggregate is relevant and it should not exceed 5 lakh, and therefore the illustrations in situation 2 would cover these kind of situations where in an earlier year the consideration had been received and it was claimed exempt. We will understand this in a better fashion when we deal with those illustrations. Now a situation which is not covered by situation 2 is basically situation 1, which means what? No consideration is received on any eligible life insurance policy during any preceding previous year, or though it was received, it has not been claimed as exempt. So we now move to example 1. So this is the case of a life insurance policy A, which has been issued on 1st April 2013, right? Annual premium 6 lakh rupees, sum assured 60 lakh, and consideration received on 1st November 2023 on maturity. So the policy has been issued on 1st April 2013. Now in all the cases that we note, we will need to check whether the policy is an excess premium policy, and we will need to check number 1 and number 2. Now in our case, in our example number 1, the policy has been issued when? Before 1st April 2023. It is 1st April 2013, and therefore second point is not relevant. So what we simply need to check is whether serial number 1 is relevant, and for that the premium should exceed the threshold. On or after 1st April 2013, if the date of issue of policy is on or after 1st April 2013, and the person is not suffering from a disability referred under section 80U or 80DDB, then the threshold is 10%. Then the threshold is 10%, and if this is not satisfied, then the policy is not an excess premium policy. So if we look at our example, 6 lakh is the premium while the sum assured is 60 lakh, and therefore the premium is 10%. It is not more than 10%, right? And the policy has not been issued on or after 1st April 2023. So both serial number 1 and 2 are not satisfied, and consequently the proceeds are not taxable. They are exempt under section 1010D. Now we need to note that in all the examples which we will now deal, which are given in this circular, serial number 1 is not getting satisfied. That means serial number 1. Okay, that means in all the examples it is the case that serial number 1 is not getting satisfied. That is, the premium payable for any of the policy years is not more than the prescribed threshold. So the illustrations will help us in understanding the case where the sum becomes taxable as per serial number 2. That means policy is issued on or after 1st April 2023 and the premium payable for any of the policy years is more than 5 lakh rupees. Or in a case where multiple policies are there, then exemption is only with respect to those policies where the aggregate amount of premium does not exceed 5 lakh in any of the policy years in respect of such policies. Now we come to example number 2. Date of issue is 1st April 2023. Okay, so as we discussed in all these examples which we will discuss, serial number 1 is not applicable because if you will note in all the examples, the premium will not exceed 10% of the sum assured. So we only need to look at serial number 2. That means whether the policy is issued on or after 1st April 2023 and the premium or the aggregate in the case of multiple policies is or is not more than rupees 5 lakh. In this case, the date of issue is 1st April 2023 and the annual premium is 6 lakh, sum assured is 60 lakh and the consideration received is 70 lakh. Now, since this 6 lakh is more than rupees 5 lakh and the policy has been issued on or after 1st April 2023, the policy becomes an excess premium policy and the sum of 70 lakh will be taxable. It will not be exempt under section 1010D. Example number 3. Date of issue is once again 1st April 2023, that means on or after 1st April 2023 and the annual premium is 5 lakh, sum assured is 50 lakh. So the threshold of 10% is not getting exceeded and the annual premium is also not more than rupees 5 lakh. It is not more than rupees 5 lakh, it is exactly rupees 5 lakh and therefore the proceeds will be exempt under section 1010D. Now we come to example 4 and in this case we have two policies basically, so multiple insurance policies. The date of issue is on or after 1st April 2023 in both the cases. Annual premium is 4 lakh 50 and 5 lakh 50 and the sum assured is 45 and 55 and this is the consideration received on maturity. Okay, now there are two policies which are involved and let's look at what did we see in the case of multiple insurance policy. What are the provisions? If the premium is payable for more than one policy issued on or after 1st April 2023, then exemption will be applicable on what? Only with respect to those policies where the aggregate amount of premium doesn't exceed rupees 5 lakh. So we need to find out what are those policies whose aggregate premium doesn't exceed rupees 5 lakh in any of the policy years. Aggregate doesn't exceed 5 lakh in any of the policy years and in this case there are policies A and B and in the case of A the premium doesn't exceed 5 lakh, so A will be exempt, while in the case of B straight away the premium is more than rupees 5 lakh, so B the proceeds from B will be taxable. We now look at example 5 and in this case we have three policies A, B and C, all of them issued on or after 1st April 2023. Premium for A is 1 lakh, for B it's 3 lakh 50,000 and for C is 6 lakh. Okay, and the sum assured is 10 lakh, 35 lakh and 60 lakh. So basically annual premium doesn't exceed 10% threshold of the sum assured. Now in this case, what is exempt? In the case of multiple policies, the sum received, the proceeds in respect of only those policies is exempt whose aggregate premium doesn't exceed rupees 5 lakh. That means doesn't exceed rupees 5 lakh in the aggregate for any of the policy years. And this is the case with policy A and B where the aggregate of 1 lakh and 3 lakh 50,000 is 4 lakh 50,000 which doesn't exceed rupees 5 lakh. So proceeds from A and B will be exempt, whereas proceeds from C will be taxable. They will not be exempt because the premium is 6 lakh rupees which straight away hits the barrier of 5 lakh rupees. We now come to example 6 and in this case we have four policies. Policy X, A, B and C. Now if you note for policies A, B and C, the date of issue is 1st April 2023 which is on or after 1st April 2023. But policy X has been issued on 1st April 2022 which is before 1st April 2023. So basically as far as X is concerned, it is not hit by serial number 2. That means the recently introduced provisions because the policy has not been issued on or after 1st April 2023. So in the case of X, we only need to see the condition of serial number 1, that is whether the annual premium is exceeding the threshold of 10% of sum assured. 5 lakh is the annual premium and 50 lakh is the sum assured. So this is 10%. It's not more than 10%. So the policy X is not an excess premium policy. That means it is exempt under section 1010D. Now what we are left with is policies A, B and C. Now here are multiple policies where the premium is paid, and all of these are eligible policies because all of these have been issued on or after 1st April 2023. So what is exempt? We need to check the aggregate of the policies and the proceeds from only those policies which will be exempt, the aggregate premium for which for any of the policy years doesn't exceed rupees 5 lakh. And this is the case with policies A and B, which is 1 lakh plus 3 lakh 50,000, 4 lakh 50,000 doesn't exceed 5 lakh. So A is exempt, proceeds from B is exempt, but proceeds from C is not exempt. It will be taxable by, because 6 lakh is the annual premium, which is straight away hits the barrier of 5 lakh rupees. Now we move to example 7. And here we have 4 insurance policies X, A, B and C. Now all of them have been issued on or after 1st April 2023. X has been issued 1 year before, that means 1st April 2023, while ABC on 1st April 2024. But all of these meet the cutoff date of 1st April 2023. On or after 1st April 2023, they have been issued, all 4 of them. And the annual premium for X is 4 lakh 50, A is 1 lakh, B is 1 lakh 50 and C is 6 lakh. And basically annual premium is 10% of sum assured. So sum assured is 10 times annual premium in case of all the 4 insurance policies. Now as far as X is concerned, the consideration has been received on 1st November 2033, and as far as A, B and C are concerned, 1 year later on 1st November 2034. Now the first policy which matures is X and 50 lakh have been received, and the question is whether this is exempt or not. Now there are multiple insurance policies, and again what is exempt is the sum received in respect of those policies where the aggregate premium for any of the policy years is not more than 5 lakh rupees. Now 50 lakh was received from policy X, and we now consider exemption for policy X because the sum of annual premium is not 5 lakh rupees, and therefore the policy X can be taken to be exempt. And we are assuming here that the SSE claimed exemption in respect of policy X under section 1010D, right? Now we come to policy numbers A, B and C. Now 4,50,000 annual premium for X, and which has already been claimed exempt, and proceeds from all those policies which will be exempt where the aggregate premium for all of them for any of the policy years doesn't exceed 5 lakh rupees. So 4,50,000 is something that we have already exhausted here, and consequently proceeds from A, B and C, all 3 of them will be taxable, will not be exempt, because if we include the premium for X, whether we take any combination of XA or XB or XC or XABC or whatever, the aggregate premium will exceed 5 lakh rupees. So what we can claim as exempt is only under policy X, not under A, B and C. Is this clear? Now we come to example 8, and in this case we just have 2 policies X and A. So if you look at the date of issue, the difference is basically of 10 years. X has been issued on 1st April 2023. 1st April 2023, while A is 1st April 2034, and the annual premium for both is 5 lakh rupees. The aggregate is coming to 10 lakh rupees basically. But what we need to note is the previous years for which the premium is paid for X, it is 2023, 24 to 2033, 34, and after that and then from 2034, 35 to 2047, 48 for A. So if we carefully note, there is no previous year where the premium has been paid by the SSE both for X and A. So till X it is 20, 33, 34, and after that the SSE starts paying premium for A from 20, 34, 35. So while there are two policies, but for there is no particular previous year in which the premium has been paid for more than one policy, right? And therefore it's not really relevant that we aggregate the premium of 5 lakh and 5 lakh and say that it's 10 lakh and therefore it's more than 5 lakh. So since there are no overlapping previous years, for each of the previous year the premium paid is 5 lakh rupees, whether it be for X or for A, which doesn't exceed 5 lakh rupees, and therefore proceeds from both X and A will be exempt. Now we come to example 9, and here we have 4 policies X, A, B, C. And all these policies have been issued on or after 1st April 2023. X has been issued 1 year before A, B, and C. Okay, and therefore X matures 1 year before, X matures first. Annual premium for X is 2 lakh 50, A 2 lakh, B 2 lakh 50, C 6 lakh. So X matures first on 1st November 2033, and in 2034, that means 1 year later, A, B, and C mature. So when X matures, and we are assuming here that the proceeds have been claimed as exempt under section 1010D, and it will be exempt because the policy has been issued on or after 1st April 2023 and the premium of 2 lakh 50 doesn't exceed 5 lakh rupees, right? So in fact there are multiple policies for which premium has been paid, and if we consider the aggregate, only those policies which will be exempt where the aggregate premium doesn't exceed 5 lakh rupees. So X straight away is 2 lakh 50, so we can claim it as exempt. Now once we claim the proceeds from X as exempt, that means out of 5 lakh rupees 2 lakh 50 is gone. So what is left is 2 lakh 50 rupees. Now C clearly is more than 5 lakh rupees, so C will be taxable. C will be taxable because there is no question of C being exempt because the premium itself is more than 5 lakh rupees. So what we are left with is A and B. Now X we have already taken 2 lakh 50,000 as the premium and we have considered the proceeds as exempt. So that means out of 5 lakh rupees still 2 lakh 50 is left, and therefore we can claim X and A as exempt, in which case the premium is the aggregate is 4 lakh 50, which is not more than 5 lakh, and also we can claim X and B as exempt where the premium is 5 lakh, it doesn't exceed 5 lakh. So there are two options, and if the SSE wants to take a position which is most beneficial to him, the SSE would like to claim X and B as exempt because the proceeds which will be exempt will be 30 lakh and 38 lakh, which will be 68 lakh rupees. But if SSE was to claim X and A as exempt, 30 plus 24, which is 54 lakh, will be exempt. So what the SSE should do, SSE should claim X and E as exempt under section 1010D, while A and C will become taxable. They will not be exempt under section 1010D. So when you have these multiple policies and there are more than one options which are available, then what you should consider are the combination of those options which result in the maximum benefit to the SSE. That means where the proceeds, the aggregate of proceeds from those policies will be the maximum, because that will give the maximum exemption to the SSE. Now we come to example 10, and here also we have X, A, B, C, 4 policies, and all of them have been issued on or after 1st April 2023. X has been issued 1 year before A, B, and C. Annual premium is for X, A, B, C is 1 lakh, 1 lakh, 1 lakh 50, and 3 lakh respectively. Consideration received for X is 1 year before, then the consideration received for A, B, and C. Now there are multiple policies, and what needs to be noted is that consideration under life insurance policy X has not been claimed exempt. So it has not been claimed exempt, so X becomes taxable. Now we need to figure out Out of A, B, and C, which are the policies which the SSE can claim as exempt under section 1010D, and we need to figure out those policies where the aggregate premium for any of the policy years is not more than 5 lakh rupees. Now, if we look at A, B, and C, the premium is respectively 1 lakh, 1 lakh 50,000 and 3 lakh, right? So to maximize the benefit, it will be good to take C as exempt and B as exempt, because the aggregate premium will be 1 lakh 50 plus 3 lakh, which will be 4 lakh 50,000. That means it will not be more than 5 lakh rupees. A can be considered as taxable, right? We could have gone for option A and B as exempt, or A and C as exempt also, but to maximize the benefit to the SSE in respect of exemption for the proceeds under section 1010D, B and C can be claimed as exempt, whereas X and T, the exemption can be foregone by the SSE, right? We now look at example number 11. And here we have 5 policies, X, Y, A, B, and C. And X and Y have been issued on 1st April 2023, whereas A, B, and C have been issued on 1st April 2024. And the annual premium for X, Y, A, B, C is 2 lakh, 2 lakh, 2 lakh, 3 lakh, and 6 lakh respectively. So X matures on 1st July 2033, Y matures 1 year later, 2034, while A, B, C mature 1 year after in 2035. And we are asked to figure out what exemptions should be claimed. And here there are basically 2 approaches. It might be given in the question. If it is not given in the question, then we can assume. Now, what is it that we need to consider is in alternative 1, we can assume that the SSE claims exemption under section 1010D as the policies mature. So SSE first claims exemption under X, then Y, and then explores whether further exemption can be claimed in respect of A, B, and C in the sequence in which the policies are maturing and the proceeds are being received by the SSE, right? So considering this approach, X matures first, and therefore the SSE says that I claim exemption under X because it is the annual premium for X is not more than 5 lakh, it is 2 lakh rupees. So out of 5 lakh, 2 lakh rupees have been exhausted. Okay. Next comes policy Y, which gets matured 1 year later. And here also X can say that, okay, I claim exemption for policy Y as well, because the aggregate for X and Y is 4 lakh, which is still not more than 5 lakh. So X and Y policies exemption is claimed under section 1010D. Now, having done so, when the policies A, B, and C subsequently mature, can the SSE further claim exemption in respect of those policies? No, because the aggregate X and Y is 4 lakh, and if you further add the premium for either A or B or C, the annual premium crosses the threshold of 5 lakh rupees. So exemption won't be available for A, B, and C. So what will happen? A will not be exempt, B will not be exempt, C will not be exempt. So X and Y will be exempt, A, B, and C proceeds will be taxable. So this is alternative 1. Now in alternative 2, which is what is basically example 12. If in example 11, that means the previous example, the SSE does not claim exemption with respect to surrender value of life insurance policy X, then what will happen? That means if say SSE does not claim exemption for X, if the SSE doesn't claim exemption for X, that means it is taxable, it is not exempt. Now 1 year later, when the SSE receives the proceeds from policy Y, okay, the exemption is claimed under section 1010D. And after 1 year, when the SSE receives proceeds from A, B, and C, then we need to figure out what are those policies where the aggregate of premium doesn't exceed 5 lakh rupees. So 2 lakh has already been exhausted under Y, right? And C, we can see, is straight away hitting the 5 lakh mark because the annual premium is 6 lakh, and therefore the C policy proceeds are also taxable. They cannot be claimed as exempt. So what is left is either the combination of Y and A or Y and B. Now the premium as well as the sum as well as the proceeds in the case of Y and B are more as compared to Y and A. It will be most beneficial for the SSE if the SSE claims policy B as exempt under 1010D along with Y and foregoes exemption under 1010D for A. So what will be the result in this case? X, A and C will not be exempt, whereas proceeds from Y and B will be exempt. Okay. Example 13 is not relevant to us very much, so we will skip this example. This example has also been skipped by the ICAI in its statutory update. Now we come to the other 2 points. What were those points? We saw in this statutory update document that the other 2 points were GST component and clarification in the case of term life insurance policy. So we will look at this. Clarification on GST component. Now GST is applicable on insurance policies, right? And for example, here an illustration is given. In the case of policy A, date of issue is 1st April 2023. Annual premium is 5 lakh, GST 4.5% of premium is 22,500 and total premium payable is 5 lakh 22,500 and sum assured is 60 lakh. Okay. And consideration received on 1st November 2033 on maturity is 70 lakh. So basically the question is whether for classifying a policy as an excess premium policy, what is the premium that we should take? Should we take 5 lakh rupees or should we include GST and take 5 lakh 22,500 rupees? Now in this case, serial number 1 of our condition on excess premium policy is not getting satisfied, because whether it be 5 lakh rupees or 5 lakh 22,500 rupees, it is not exceeding 10% of 60 lakh. So that is not met. Now coming to serial number 2, which pertains to the recently amended provision, the policy will be exempt under 1010D if the premium does not exceed 5 lakh rupees. Now if we just take 5 lakh rupees without including GST, then the policy will be exempt because it doesn't exceed 5 lakh rupees. But the moment we include GST, the premium exceeds 5 lakh rupees and therefore 1010D exemption will not be available. So the question is whether we should add GST or not. So it has been clarified that the premium payable or the aggregate premium payable in the case of multiple life insurance policies issued on or after 1st April 2023, which is other than a unit linked insurance policy. Unit linked policy we are excluding because, as I noted before, this is not a part of the CA intermediate syllabus. So unit linked insurance policy we exclude. So basically what they are trying to say, what the board is trying to say is that the premium will be exclusive of the GST payable on such premium. That means the GST will not be included and therefore we will not take 522,500 here. We will take 5 lakh as the premium and consequently exemption will be available under section 1010D. Now the second clarification is in respect of premium of term life insurance policy, right? So we would have heard about term life insurance policies. And the question is, what is a term life insurance policy? The term life insurance policy is issued for a particular term, right? Where the sum under a life insurance policy is only paid to the nominee in case of death of the person insured during the term of the policy. So for example, if we take a term life insurance policy for say 10 years and we pay the premium in respect of that policy. So a term life insurance policy will say that the sum assured will be paid only in case of death of the person insured and the sum therefore will be paid to the nominee. And as we noted section 1010D, in the case of death, whether it even if it is an excess premium policy, then in case of death the proceeds are exempt under section 1010D. What is taxable are the proceeds in the case of excess premium policy only when received, otherwise then on death. The exception is scheme and insurance policy, where even in case of death, when the proceeds are received, the sum becomes taxable. But for excess premium policy. In the case of death, it is exempt. So no amount is paid to anyone if the insured person survives the policy tenure. So the premium is paid, but the sum assured is not paid back because the insured person survives the term of the policy, and therefore no amount is paid to anyone. The amount is only paid to the nominee in case of death of the insured. Hence, any sum received under a term insurance policy shall continue to be exempt under Section 1010D of the Act, irrespective of the amount of premium payable, irrespective of the amount, because excess premium policy is exempt under Section 1010D in the case of death. Further, the premium paid for such policies shall not be counted for checking the 5 lakh limit for the purposes of 6th and 7th proviso. So for excess premium policy, when we, in the case of multiple policies, when we aggregate the premium for these policies, we obviously will not include the premium which has been paid for a term life insurance policy, because the premium in respect of such policy is clearly exempt under Section 1010D. So why should we aggregate the premium with the premium paid for the other policies? So this is the clarification which has been issued. We will now move to the second item which we need to consider, which we need to note, which is in respect of Section 43B, para 118 of TaxBook Plus. And this is in respect of Section 43B. If you look at Section 43B, serial number 8 is a particular sum which is now covered by Section 43B, and this is the amendment which was brought in by the Finance Act 2023. So any sum payable to a micro or small enterprise beyond the time limit specified under Section 15 of the Micro, Small and Medium Enterprises Development Act, basically MSMED Act 2006, is covered under Section 43B, and therefore it is disallowed in accordance with this provision. And under the MSMED Act, the classification is also provided as to which enterprise is classified as micro and which enterprise is classified as small. And this table is given on page 193 of TaxBook Plus. Now, what we need to note is the amended classification, right? So instead of the table on that page, this is the classification that you should note, and this applies to both manufacturing enterprises as well as enterprises rendering services. Now, an enterprise is classified as a micro enterprise when investment in plant and machinery or equipment is not more than 1 crore. And so both the conditions, turnover is not more than 5 crore. So the criteria in respect of investment and turnover both needs to be satisfied. And in that case, the classification will be that of a micro enterprise. Similarly, for small enterprise, the investment in P&M or equipment should not be more than 10 crore and the turnover should not be more than 50 crore. So if you look at strictly, you basically need not remember this classification, though it will be good to make a note because this classification is as per the MSMED Act and not as per the Income Tax Act. So most likely in the ICAI question, if the question comes on this particular point, the question itself, I think, should state whether the enterprise is a micro enterprise or a small enterprise. It is unlikely that you will be given these figures of investments and turnover and then you will be asked to classify the enterprise as micro or small under the MSMED Act and consequently solve the question. So for the sake of completeness, it will be good to note this amended classification. So this brings us to the end of the statutory updates on income tax. So we now come to the GST part, and we will look at the statutory updates for GST. If you are studying from TaxBook Plus and preparing for CA Inter May 2024 exams. Now, it's basically a 2-pager document with a couple of updates. The ICAI has also recently released the statutory updates for May 2024 examination for GST, and this is a long list. This is a long list of updates which the ICAI has released, basically a 30+ pager document, and these contain the updates from 1st May to 31st of October 2023, because the study material of the ICAI has updated only till 30th of April 2023. But we will not discuss all the updates which are there in the ICI document, because most of these are already incorporated in TaxBook Plus. So what we are simply going to look at are the couple of updates which are now relevant as far as TaxBook Plus is concerned, and then you will be fully up to date for your exams. So the first update that we look at is in respect of supply of food or beverages in cinema halls. And this is para 25. Para 25 deals with the case of composite supply, right? So basically, whenever we go to a cinema hall, we might encounter a eating stall or a kiosk or some counter or some kind of a restaurant at the cinema. And we go and we get the ticket for the movie, and then we watch the movie as well as we enjoy refreshments, food, beverages, etc. And the question is, what should be the classification or what should be the treatment of such refreshments, supply of food or beverages? Should it be considered as restaurant service, right? And treated independently of the cinema exhibition service. So cinema exhibition service is the service where you go and watch the movie. So you get the ticket for the movie and then you go and watch the movie. That is cinema exhibition service. And then there is this food or beverages that are supplied in the cinema hall. And the question is whether they should form part and parcel of the cinema exhibition service, or they should be treated independent of the cinema exhibition service and considered as restaurant service. Now, in this particular context, what is relevant is the concept of composite supply, right? And this is para 25 of the TaxBook, where you will see what is composite supply as per section 230 of the CGST Act. Composite supply means a supply which consists of two or more taxable supplies. So in this case, food and beverages, that means the restaurant service as well as the cinema exhibition service. So two or more taxable supplies of goods and or services or any combination thereof. And the second condition is which are naturally bundled and supplied in conjunction with each other in the ordinary course of business. So the point is whether the food and beverages supply as well as the cinema exhibition service supply is naturally bundled and supplied in conjunction with each other in the ordinary course of business, one of which is a principal supply, right? In that case, the supply will be treated as a composite supply, and the composite supply will be classified as the principal supply, and the entire value will be taxable at the rate applicable to the principal supply. This is what we have already studied. And now look at the clarification which has been provided in this respect. So what they say is supply of food or beverages in a cinema hall is taxable as restaurant service, right? Not as a cinema exhibition service, but as a restaurant service as long as two conditions are satisfied. A, the food or beverages are supplied by way of or as part of a service, right? So there is a service and the food and beverages are supplied by way of such service or as part of such service. And the second condition is that they are supplied independent of the cinema exhibition service. So you have a ticket which entitles you to avail the cinema exhibition service. You can watch the movie, and independent of that, right, you also enjoy refreshments, and therefore such service for supply of food and beverages will be taxable as a restaurant service, while the enjoyment of the movie will be considered as cinema exhibition service, and both will be treated separately. However, in another case where the sale of cinema ticket and supply of food and beverages are clubbed together, they are clubbed together. So what you get is the service of enjoying the movie as well as the refreshments. So both are clubbed together and such bundled supply. So they are bundled and they satisfy the test of composite supply, right? This is what we looked at, which are naturally bundled. So both the supplies are naturally bundled and supplied in conjunction with each other in the ordinary course of business. If that be the case, then the entire supply will attract GST at the rate applicable to the principal supply. And the principal supply in this case will be service of exhibition of cinema, right? So in such case, the refreshments or the food or beverages supply will not be considered as a restaurant service, but rather it will be treated as a composite supply, and the principal supply being the service of exhibition of cinema. The entire supply, both the supplies will be taxable at the rate applicable to the service of exhibition of cinema. The next update is in respect of services provided by Ministry of Railways or Indian Railways. So basically what has been done is, now supply of all goods and services by Indian Railways shall be taxed under forward charge mechanism, right? To enable them to avail ITC, and this will reduce the cost for Indian Railways. So basically what is the position right now? Just in brief. Para 31.3 of TaxBook Plus deals with reverse charge, and 31.3 reverse charge for government services, and this is what we know. Entry 5 and 5A are relevant. So in respect of services supplied by the central government to a business entity, reverse charge mechanism applies. That means the recipient is supposed to pay tax. The government is not supposed to pay tax. However, there are certain services which have been excluded. So we know services by Department of Posts, Post Office services are excluded. So forward charge applies, reverse charge doesn't apply. So Post Office pays GST. Of course, certain basic postal services are exempt, as we know, which is listed in the exemption chapter of TaxBook. Then services in relation to an aircraft or a vessel, transport of goods or passengers. So basically, if Indian Railways transports goods or passengers, then reverse charge mechanism doesn't apply, and the railway is supposed to pay GST. But railways also may provide other services as well, leasing of its equipment, renting of an immovable property which is owned by it. But reverse charge doesn't apply only in the case of transport of goods or passengers. So while in the case of all other services which are taxable, which are provided by Indian Railways, that means the Ministry of Railways, central government, reverse charge applies, right? As far as renting of immovable property is concerned, entry 5A, this is excluded from entry 5 because it is covered specifically under entry 5A. And in such case also, the current position is that the central government, which includes the Ministry of Railways, Indian Railways, if it rents immovable property owned by it to a registered person, then reverse charge applies, right? That means forward charge doesn't apply, and the railways, the Ministry of Railways is not required to pay GST. Rather, the recipient is required to pay GST. In the exemption chapter, we have also noted that as far as transport of goods or passengers is concerned, transport of priority goods is exempt. Tax is not levied, and therefore the concept of reverse charge and forward charge, the payment of GST, doesn't arise in the first place. As far as transport of passengers is concerned, we know that transport of passengers by Indian Railways in a non-AC coach is exempt. So subject to these exemptions, or as far as all other services are concerned, transport of goods or passengers is taxable on forward charge basis, not on reverse charge basis. And all other services are taxable on reverse charge basis. Now, the amendment intends to provide that supply of all the goods and services shall now be taxed under forward charge mechanism. So reverse charge mechanism goes off in the case of services provided by Ministry of Railways or Indian Railways. And how will it help? It will enable them to avail ITC because they pay GST, and then they will be able to avail ITC. So consequently, this will reduce the cost for Indian Railways. So accordingly, a couple of amendments have been made. So first, we look at the amendments made on the reverse charge front. So entry 5, services provided by central government, which is the Ministry of Railways in our case, to any business entity till now has been subject to reverse charge mechanism. But now what has been done is services by the Ministry of Railways, Indian Railways, have been excluded from this reverse charge mechanism, meaning thereby that the services by the Ministry of Railways, Indian Railways, Okay, transport of goods and passengers was already there, but all other services by Ministry of Railways will be out of reverse charge mechanism now. That will enable the railways to pay GST and avail ITC thereon. Okay. Now, what about renting of immovable property? Renting of immovable property is out of entry 5 and it falls in entry 5A. So, what if the railways owns immovable property and rents out to a registered person? To a registered person. So, reverse charge applies. But now what has been done is, as far as central government is concerned, this excludes the Ministry of Railways, Indian Railways. So the Ministry of Railways or the Indian Railways is out of entry 5A. What this means? This means that forward charge will apply. Reverse charge will not apply. So in effect, what is happening is the supply of all the services by the Ministry of Railways or Indian Railways is now not subject to reverse charge mechanism. It is subject to forward charge mechanism. Railways will be paying GST. We also need to note the exemptions chapter and services provided by central government to a business entity, irrespective of whether the ATO is more or less than the registration threshold, it doesn't matter, or services supplied to central government, state government, union territory or local authority, or to any other person. So now this entry has been added. So services by the Ministry of Railways, Indian Railways will be taxable. Cross means not exempt. So taxable in all the cases. So basically services by the Ministry of Railways or Indian Railways will be taxable, okay, on forward charge basis. On forward charge basis. Of course, the existing exemption in respect of transport of priority goods and transport of passengers by Indian Railways in non-AC coach continues. Next update is in regard to passenger transportation by Omnibus provided by a company. And para 33 is the relevant para. And if we look at para 33 of tax book, it is tax payable by e-commerce operator under section 9.5. So as we know, under section 9.5, certain services have been notified. In respect of such notified services, if such services are supplied through an e-commerce operator, then who is required to pay tax? The e-commerce operator is required to pay tax, not the actual supplier, if the services are supplied through such e-commerce operator. And there are 4 services which have been notified, as we know. Transportation of passengers by a radio taxi, motor cab, maxi cab, motorcycle, omnibus, or any other motor vehicle. And then we have accommodation service, housekeeping service, and restaurant service. In such case, the e-commerce operator pays the tax and not the supplier. In case of services which are not notified under section 9.5, what happens? The e-commerce operator is not required to pay tax, but the e-commerce operator may be required to collect tax at so TCS. And the supplier will then be able to take the credit of TCS. So what is the change that has been made? The change has been made in respect of passenger transportation service. So this is serial number 1 that we just now looked at. So what has been done is, everything remains the same except the omnibus part. The omnibus part has been removed from serial number 1 and it has been taken and to serial number 2, which is a new entry which has been carved out. So omnibus has basically been taken as a new entry, whereby it is provided that transportation of passengers by an omnibus is notified under section 9.5 except where the person supplying such service through e-commerce operator is a company. So till now, what was the position? Transportation of passenger service by an omnibus was notified under section 9.5. That means in all such cases, whether the supplier, that means the omnibus operator, was a company or not a company, irrespective of the form of entity, the e-commerce operator is supposed to pay tax under section 9.5. But now the e-commerce operator is not supposed to pay tax under section 9.5 where the operator, that means a person supplying such services of passenger transportation by an omnibus, is a company. So that means if the transporter is a company, the e-commerce operator will not pay tax because section 9(5) will not apply. In such case, the e-commerce operator may be liable to collect tax at source in accordance with those provisions. But if the transporter is not a company, then section 9(5) will apply as per this entry, and then the e-commerce operator will be liable to pay tax. So the difference between the existing position and the new position is that if the transportation of passengers by an omnibus is provided, if the service is supplied by a company, till now the e-commerce operator was supposed to pay tax under section 9(5). Now, from now on, e-commerce operator will not be required to pay tax under section 9(5). TCS provisions may apply and the tax liability will dwell on the company supplier. What is omnibus? We know that it's a motor vehicle constructed or adapted to carry more than 6 persons excluding the driver. The next update is in regard to the exemptions. A new entry, and this is para 48 of TaxBook Plus, entry 3B, and it provides exemption where certain services are provided to a governmental authority. Governmental authority. And what are those services? Services by way of water supply, or public health, or sanitation conservancy, solid waste management, and slum improvement and upgradation. So these services will be exempt, tax will not be payable. So the question is, what is a governmental authority? It has been defined as an authority or a board or any other body set up by an act of parliament or a state legislature or established by any government. And what is the condition? With 90% or more participation by way of equity or control to carry out any function entrusted to a municipality or panchayat under the constitution. Okay, so the government should have 90% or more participation by way of equity or control, and such authority or board or any other body should be set up to carry out what? Any function entrusted to what? To a municipality or panchayat under the constitution. So water supply, public health, sanitation conservancy, solid waste management, slum improvement and upgradation. So all these services, if they are provided by a person to a governmental authority, GST will not be payable and these will be exempt. The last update is in respect of place of supply. In case of services in respect of advertising sector. And what is affected is para 58C.2 of TaxBook content has been added because there are certain clarifications which have been provided in respect of advertising sector services. Now, whenever we go out, we notice hoardings or billboards where we find advertisements, which are displayed. And basically these hoardings or billboards, so for example, if we look at this is say a hoarding or a billboard which we find on the road, right, or a highway or an expressway, and this hoarding or billboard is owned by we, say the we is the vendor, right? So this is owned by the vendor, or the vendor may have taken it from someone else, or the vendor may own this particular structure or space itself. And then there is this advertising agency, and advertising agency has a client. So advertising agency basically enters into a contract with the client, and the client says that, look, I want this product to be displayed as an advertisement on this beautiful hoarding or a billboard which is in this prime location. So advertising agency basically reaches out to the vendor and says that, look, I have an advertisement of my client which I want to display. And then the vendor says, okay, I give you this space. So basically I supply you this space. So I sell you this space, okay, and you use it, you occupy it. So the advertising agency is an occupation or in possession of this space, and it then displays the advertisement of this particular client, and or maybe some other clients as well. So the advertising agency pays the vendor in respect of this space, and the client in turn pays the advertising agency. And what you see while you are on the road is this beautiful advertisement on a hoarding or a billboard. So Certain clarifications have been issued as to what should be the place of supply in case of such services which are provided by the vendor to the advertising agency in respect of such hoardings or billboards. And there are two situations which are possible, and let's see the clarification issued in respect of each of these situations. So situation number 1 and situation number 2. So in situation number 1, there is a supply or sale of space, right? So vendor has this space and vendor supplies or sells this space to the advertising agency. Or there is a supply or sale of rights to use this space. So vendor may give the right to use this space to the advertising agency. And this particular space belongs to whom? It belongs to the vendor, right? So there is a supply of a space or supply or sale of rights to use the space on the hoarding or structure. And this hoarding or structure can be constituted as what? Immovable property. Why? Because it is affixed on the ground. So it may not be rightly classified as a movable property, but rightly as an immovable property. So there is a supply sale of space or supply sale of rights to use the space on the hoarding structure, which is constituted as an immovable property and it belongs to the vendor. And the supply is to either the advertising company or the vendor may directly give this to the client, and the client may be in possession or in occupation of this particular immovable property and host its advertisement. Or there may be an advertising agency in between who may take the matter from the client under a contract and then host the advertisement on this hoarding or billboard which belongs to the vendor for display of advertisement on the said hoarding or structure. Now the clarification is that this hoarding or structure erected on the land should be considered as immovable structure or fixture. Immovable. Why? Because it has been embedded in earth. So therefore the question is, what will be the place of supply? So place of supply of any service, and what is the service in this case? It is supply or sale of space on an immovable property or grant of rights to use an immovable property. This is a service which has been rendered by the vendor to the advertising agency or maybe directly to its client. So this place of supply determination should be governed by section 12.3. What is 12.3? We have noted in the place of supply chapter of TaxBook Plus 58C.1 para, sorry, 58C.2, section 12.3, and this deals with immovable property. And basically 3 categories of services in respect to immovable property have been provided: direct services, lodging, and function. So in our case, advertising service, direct services, let's look at it. Services directly in relation to an immovable property. So as we said, holding or billboard is to be constituted as immovable properties. So services directly in relation to an immovable property, it's included. Also service provided by way of grant of rights to use. This is also what it is something that we are talking about. So in these kind of services, the place of supply is what? Location at which the immovable property is located or intended to be located. Location at which the immovable property is located or intended to be located. So what does the clarification say? Therefore, place of supply of such service provided by way of supply of sale of space on hoarding or structure for advertising, or for grant of rights to use the hoarding or structure for advertising, in this case, since it is in relation to an immovable structure or fixture, section 12.3 that we just now saw applies, and therefore the place of supply of such service would be the location where such hoarding or structure is located. Okay. So if say this is in, if the hoarding or billboard is in Maharashtra and the vendor is in Karnataka and the advertising agency is say in Gujarat, so the place of supply in respect of this service will not be Karnataka, will not be Gujarat, it will be Maharashtra, because this is the location of such hoarding or structure, and the place of supply will be governed under section 12.3. Now we look at situation 2, and this is a bit different. And it says that the advertising company wants to display its advertisement on hoarding or billboards at a specific location availing the services of a vendor, right? So it has a contract with the client and it now wants to display its advertisement on a hoarding or billboard availing the services of a vendor, Now, in this particular situation, the responsibility of arranging the hoarding billboards lies with the vendor, who may himself own. So the vendor owns the structure, or the vendor may have taken it on rent or rights to use basis from some another person. It doesn't matter. So the point is, the vendor is supposed to supply the services. The vendor is responsible for display of the advertisement company at the said location. In situation 1, the advertising company was in possession of the structure and was displaying the advertisement on the structure which was in its occupation. But in situation 2, the structure is not in occupation or in possession of advertising agency, but it is in possession occupation of the vendor, and the vendor displays the advertisement of the advertising company at the said location. During this entire time of display, the vendor is in possession of the hoarding structure, and the advertising company is not occupying the space of this or the structure. This is the difference between situation 1 and situation 2. In situation 2, the vendor is in occupation or possession and is displaying the advertisement for the advertising agency. But in situation 1, the advertising agency was in possession or occupation of the structure and was using it to display the advertisement of its client. So in situation 2, what will be the position? As the service is being provided by the vendor, to whom? To the advertising company or the advertising agency. And there is no supply or sale of space or supply or sale of rights to use the space on hoarding or structure which is an immovable property by the vendor to the advertising company for display of their advertisement. The said service does not amount to sale of advertising space or supply by way of grant of rights to use a movable property, because the space is not being supplied to the advertising company and the rights to use the space is also not being supplied to the advertising company. Rather, the vendor is displaying the advertisement of the advertising company on the billboard or the hoarding which is in possession or occupation of the vendor. So what is the vendor doing? What is the service that the vendor is supplying? The vendor is in fact providing advertisement services. It is not covered under section 12.3 that we discussed, because vendor is not supplying space or supplying rights to use this space, but rather the vendor is providing advertisement services by providing visibility to an advertisement company's advertisement for a specific period of time on his structure possessed or taken on rent by him at the specified location. So he is in fact providing visibility to the advertising company's advertisement for a specific period of time under the contract. And therefore, such service provided are purely in the nature of advertisement services. And therefore, what will be the place of supply? It will be governed not by section 12.3 but by section 12.2. By section 12.2. And what is section 12.2? Section 12.2 is the by default general provision. So 12.3 was specifically in respect of immovable property, but as we discussed, this doesn't apply. What applies is the general rule, which is section 12.2. And since in most of the cases the supply will be made to a registered person, that means the advertisement company, the place of supply will be the location of such person, not the location of the hoarding or the billboard, which is the immovable property, because 12.3 doesn't apply. It will be location of such person. Such persons means the registered person, that means the advertisement company. So in this case, if we look at this particular example, what will be the place of supply under situation 2? It will be Gujarat. Advertising company being a registered person, the place of supply will be the location of such person being Gujarat. So in situation 1, the place of supply will be Maharashtra. In situation 2, the place of supply will be Gujarat. So this is all about the GST updates. So with this, we have concluded our discussion on the tax book plus statutory updates for both income tax and GST. Feel free to reach out to me or write in the comment box if you have any doubt or if you need clarification on any point or any issue that I have discussed in this video. Just feel free to reach out to me, and I'll see you once again shortly in another useful video which I'll make for you. Until then, Best of luck. All the best for your studies. Good luck. Goodbye.